Hello, every single one of you beautiful people. It's of FOMC. Let's get it. It is party time. Today might be the change that Jerome Powell we have been expecting him to do for so long. I just need to hype myself up because I think this is Christmas, Easter, 17th of May. It is everything that you would wish for. So I have coffee, I have soda, I have cola. I have lemonade or soft or whatever you guys call it. It's just flavored waters. And I have also my very old water bottle. And I don't see that open it either. I have suited up. Sorry, you can see it. I have suited up. I have put on my nice clothes today because today is a high day. Well, just maybe our life today that's going to be this way. But it was gonna have a lot of fun. So I think that what is going to happen today, I think market's gonna be surprised. I just don't know which surprise it's gonna be really. FS Pro says no tapering today. That is a reality. That is a reality, FS Pro. That is a strong reality. Another reality is that we might not taper. We will taper, but not 15 billion a month. We will taper maybe 10. So, what is happening today, people? I hope that you are ready to gain some in the end of it. I am at least expecting to... I'm not expecting to trade, but I hope I can get some trades on. I hope there's going to be a pullback on some of my trades, and I hope that we are not going to be. I hope not. We are not going to be kicked out of all our positions. That is what I think. And then I also think that gold is going to be very volatile today. So if you have anything to lose, today is the day. So we have 14 minutes left until the FOMC statement being pulled out. What does that mean? That means there is a statement. There is a sheet that we need to look through, and then by that time we need to have done our analysis. We need to have done our we need to have put up our all our news channels. We need to get ready, and also we're gonna find the live stream for the Jerome Powell speech as well. And by the end of it, I think if you are a daily setup dude, I think we're gonna jump over that today. I need to send out an email to you guys, but here I am. I haven't done it yet, so yeah. Please be patient with me, I guess. Alive, living on, I guess. So today, Zoom meeting might will be at a random time. Sorry for the greens. Check out for, what do you call it? Check out for recordings tomorrow morning. There is a lot of things that I want to there is a lot of things that I want to do. There's a lot of things that I want to do today, so I think something is going to be suffering there. But anyways, Diana is here. Denise is here. Dave is here. Would you have a good story and a bad story when it comes to gold? Yeah, sure. Just bring it on, brother. I have a position on gold. Just be patient. I know that people are loaded up in gold. I have done my part there. I have announced my opinion a long time ago. And I have said to you people, if you trade gold today, expect the unexpected. Okay? Hello! Anyways, so that is me hyping you guys up. I hope you guys are having a great time. We're going to have a party time today. We are going to be professional, by the way. We're not going to do anything stupid, but we have our accounts ready. If we have a clear reaction, a clear, straightforward message from the Fed, either bullish or bearish. What is the difference between Powell and a dove? Music, Hedrick? I don't know. Please tell me. I know there's a joke somewhere. Powell has no wings. That's a good one. How is it sounding so far? Hello, Marilyn. Hello, Alexander. Hello, Sharon. Is there anybody new here today? That is what I would like to do. Gold and silver can rally, but will crash a little from now until next week. Then it's time to buy. We shall see. We shall see. We have 11 minutes left. So, let me get this straight. What does the market want? What is the market expectations? Nothing. Well, there is market expectations. First market expectation is that there's going to be a taper of 15 billion a month from 120 to 105. That is going to be the first one. 5 of them is mortgage-backed securities, and the other one is the ordinary ones, government bonds. And then the other thing that the market is expecting is that we are going to increase interest rates within 2022 at some point, or even 2 times in 2022. And if that is going to be pushed back, that is dollar bearish. So, yeah, that is why I'm going to trade after the fact, once we know what is happening. Yeah, so gold will go down. First time here from Amir Sharez. Thank you very much for joining in. I am just going to say one thing to you, bro. Yeah. Okay. I sent an email to myself, and I'm looking at I'm looking at I'm getting an email. I'm like, it was myself sending it. Anyways, yeah. So what I sent to you, if you want to join my Discord, that would be lovely. If you wanted to subscribe to this channel, that would be lovely. But I want to be here for you. If you have any questions, please bring them on. I am here to help you out. I, generally speaking, also have a strategy video out there as well. I should have found it for you. But, you know, I am myself, and I sometimes just lack things to do, I guess. So, there we are, and then we are live. Good. And then we need to go to videos, I guess. And we go to pivot points. Why didn't I just do that in the first play anyways? So this one. Nope, I'm not gonna do that. I'm gonna do that, and then 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 that, and that, and that, and that. So that is, let's see, my strategy, quote unquote, and then the other one up here, which is this one here. Also add that one to that one, and then we are good to go. Good. Then I have found everything I want to do. Replace pin, great. So back into this one, there's 8 minutes left. The other thing that the market is expecting is to hear about what Powell thinks about a bit of a slowdown in the economy that we have been seeing. So we need to know what is he thinking about that. And also, is this inflationary, according to Jerome Powell, still transitionary, as he has been continued to say for a very, very long time? So I'm just wondering what is happening. Okay, so if we then go into gold, I have a lot of things up here. I'm sorry that I am bombarding you with all the things. I also want to see this one getting changed for tomorrow. We need IG clients as well after some time. We need, of course, we know what will happen if we all, you know, just everything just crashed. So we know what's going to happen anyways. So we don't need to look at the currency strength. We know what is strong and what is weak. Then we have Forex Live up there. And then we are going into the markets. Dollar is a red candle at this hour, but it's a very small red candle. We have Euro Dollar. Went lower today, went back up again. Okay, still at 1582. Nothing more there. Gold has fallen today. Finally. I am a bearish bias on this one, but Powell can say something, and then this can go back up again. So if you have sold right around now, you are in deep waters. Did you take the short on New Zealand dollar, Xavier? I'm too weak, bro. I'm too weak, bro. Do I have a sell on New Zealand dollar? 71.37. That's like 38. 71.38. I have a sell there. And that is it there? 37. Oh, it's even there. Okay, 37. There, that's my sell. My sell time. Basically, 3 pips in profit. The good story is I stick to with your plan. Selling gold at 1783. I bought at 1768. All cash with 21 pips benefit. Bad story. Somebody else bought at 1785, and that has made me lose $800. Okay, that is unfortunate. For the last year, Powell has read the same script for every few weeks. Maybe he can wear a new tie today and read a new script. We want to hear the new script today. Definitely. So we need to find the Federal Reserve.gov to see where. Then we need to go to monetary policy, and then we're good to go. So why is this important? Because interest rate expectations is the core driver of the prices of a currency of an economy. Therefore, also the currency. Therefore, the currency. A currency is the reflection of the value of the economy. Okay? So when you are expecting increasing interest rates in an economy, it doesn't matter really which one it is, that is going to lead for demand for that currency. So if we are then going to be having hopes and prayers being heard about an interest rate hike earlier than expected, dollar is going to be strong. But he has said before, we are seeing two different things here. So we are first going to taper, then we are going to start increasing interest rate if then the market and everything appropriately fits that. The next thing to know is NFP on Friday. Okay, we have NFP on Friday. We will get a jobs report then. That might actually be another dollar bull potential market moving day. So yeah, there we go. Financial juice, economic calendar. I don't know what I have been googling here, mister, but I guess it's me and Harold. I just need to remove all my shenanigans, I guess. And then Norway has seen the green light for rate hike in December. Anyways, the only paper points you will ever need, what Jerome Powell just said, YouTube, and then there we go, and all those things. Great. Fantastic, I'm ready. Are you ready? Are you ready? Yeah, I'm sorry, I don't need to be so hyped up. Sorry. I will take it down. S&P 500 is currently at a higher high currently. The all-time high, sorry. There we go. 1750 to 1700 is a buy zone, and 1780 is too high. Okay, cool. And then I'm gonna actually add 2 screens here today. I'm gonna add S&P 500, and then the other one, that's a 1 minute chart. That was a bit low, mister. That's a bit of 1 hour, and then we go to gold, I think. So what minute time frame should we have on gold? Should we have 5 minutes? 5 minutes on gold, ish. And then this one is S&P 500, give or take, I guess. And then we can do that, and then that, and that. Cool. So well, let's see. Last time I blew my account on gold. Yeah, sorry about that. Powell will tell us inflation and inflation, blah, 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 blah. And the market will swing back up and down. Thank you very much for 100 viewers right now. We are all ready, set and go, I guess. I'm just waiting for this one to say go, and then I will go. Then we have, yeah, ciao. What do we have? We have 1 minute left, 59 seconds left. That's always, always, always great. Do you know what happened to that OPEC meeting? I haven't seen any OPEC meeting today. I have seen that the oil reserves was much higher than expected so far today, I think it was. So we are expecting gold oil to fall more. But yeah, so I need to put up this one, financial dues-ish, Forex-ish. And then I need to put up this one somewhere else. Can we just do this maybe? Can this work? Give or take. Something like that. Oi! Oi, 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 oi. Let's see how things goes. You're watching pound dollar. Somebody needs to watch euro dollar. And I need to watch my account. It's all fun and games, eh? It's all fun and games. It's all fun and games. We are ready. Gold falls at the first candle. And that was the reaction at least. Let us go. It's going green. What are they saying? I am falling. Go on, mate. Gold is a bit rising at the moment. Losing a bit more. S&P 500 is going higher. Gold is going higher. Euro is going higher, I can see. The Fed says... where is it? They're not going to taper? They're not tapering. They're not tapering. Oh, my lord. Why is this one not working? Come on, mate. Financial dues. Why is it not working? Jesus. That's... Surely? They didn't taper? Well. Why am I reading? Why? Well, okay, maybe I'm reading wrong then. What are you guys seeing? Dollar got weak. That's what your prediction was. They kept the interest rate at whatever it was supposed to. And they are... Because I still see 80 billion and 40 billion. Until substantial progress has been made. Since then, there has been some progress. If the continues as expected, continues to moderation, as a purchase may soon be warranted. Comparable decreases in buying pace are likely reasonable each month, but are willing to adapt if it's necessary. I guess that's why we had dollar bearishness first of all. I don't know why, I can't see. But we have a higher high on the S&P 500. We have gold still just doing whatever. Euro had a new high there, or up to resistance at least minimally. Gold is now going a bit lower. Fed maintains its target range of the Fed funds rate at 0 to 0.25%. Pledges it to keep it there until a 3-part test on employment and inflations are met. Inflation is currently met, but they're just waiting for the... Still just waiting for the unemployment, which is coming on Friday, by the way. So, then me and Nick are going to have some fun there too on Friday. So, yeah. I guess that's because it's just that's delayed. That's all. Starting mid-December, Fed advises the New York market desk to adjust to market open market purchases of treasuries to 60 billion per month and 30 billion per month of the mortgage-backed securities. So they are tapering. Then I'm wrong. Taper now, 15th of November. That is today. Sorry, not today, but now in November. And then I'm expecting them to also taper and be done tapering by July. But I don't know if I can find that though. July? No, it doesn't say that. July. Ah! There's nothing about July. So I think they're just going to see that. But at least so far as I remember, that is the expectations of the market, is that we're going to taper until July. Like we're going to go one of the strongest tapers in history, where we're going to see tapering until July. And by the way, gold did not move as much as I feared. So that is great. That is what I want to see. I'm still under the weather here, but nothing really bad is happening right now. Still in profit though, so I'm good to go, I guess. Is gold going to go down? Says Jazz, and I'm expecting still that the recent inflation is still largely transitionary. That's still holding on to the transitionary start. Starting in mid-December, the Fed advises the New York Fed desk to adjust to market operation. Yeah, I just said that. Fed reduces treasury purchases by 10 billion and mortgage backed by 5 billion, which is what the market expected it to do. Gold is currently now going a bit higher. On the 5-minute, but it's still a couple of dollars. Nowhere near where I expected the market to go, but that's that it is. All he says, bada bing, bada boom. We're still going down. Should I put my stop losses? You should always have stop losses, bro. But yeah, so we have a green candle on the 5-minute on gold. That doesn't mean anything else than right now we have Res, which says there's a buy on COT, buy gold. Yes, there was a more bullish sentiment to gold, yes, but it is still not enough. GBP is jumping, I guess higher. Not really, a bit. I wouldn't call that jumping, Denise, but that is something at least. And then I'm checking out my Telegram channel as well. The path of the economy is still determined by the coronavirus. The Fed has decided substantial further progress to test for tapering purchases has been met. Of course, that is kind of duh. Similar reductions in purchase pace are likely to appreciate each month, but be prepared to adjust if necessary. So that is S&P is going up. Yes, I have already mentioned that. S&P is going to an all-time high. It's not necessarily tapering. It's not necessarily a bearish thing for the market. Remember, the reason why we taper is because we are very, very strong. And that is still to be seen that the businesses are still going to make money. So yeah, I think it's going to retrace and then rise. S&P 500 is up. OPEX, BTC, sir. BTC is a couple of seconds away. I am there. Okay, that is a lower low. Why, Eivin? 100 people are now watching. Thank you very much for every 129 of you. Thank you very much for being here. Is there any trade plans at the moment? I am still in some sells, buys on dollar, by the way. So if you look at dollar index, we have a red candle. Let me see if I can find that one. There is a nope, nothing in there. There's a red candle on the dollar index, but we're not falling yet. So at least that is what I'm hoping for, at least. So I'm still hoping for this one to go higher, but there is no guarantee whatsoever. So thank you very much, Don Kirky, for mentioning that I'm a small YouTuber. So if you want to join in on fundamental analysis, technical analysis, trend trading, 300 pips moves that I posted yesterday on the not that one. Yesterday on the channel. Where is it? There is Legend. So this is what I posted yesterday on Aussie dollar for this month. Sorry, October. 308 pips. Tja, it went okay. It went okay. The other part here is, we're gonna look into what the Fed now says about future interest rates. I think that is kind of what the market is waiting for at the moment. Fed instructs the New York Fed market as to adjust its market operation of treasuries to $7 billion per month of treasuries, 35, which is still just the same, bro. Starting mid-November. Just said that 2 minutes ago, but okay. You guys are just redoing yourself. Sir, what is tapering? In simple words. In simple words, tapering is... okay, I can give you something. Okay? I can give you something. Tapering in simple words is your big sister giving you candy every Saturday, but this next Saturday she's going to give you less candy. Okay? So in simple words, the FOMC, no, the Fed has been supporting the economy, the economy with giving them 120 billion every month. Now they're just going to give them 105 billion per month. So tapering is reducing, basically, in very simple words. I think that was simple enough. Agree? Agree. Shaikh says, what about US 30 and gold? We're looking at gold at the moment, so you just use your eyes. Your eyes is there, I guess. We can see gold not really having the strong reaction I actually expected it to have. Gold is a bit falling right now. It went up to 1770. Now it's at 1763. That is the current price. There is no calls about what is going to happen next on gold. If you still have your bearish buys, I think it's still intact. By the way, Fed is cutting their allowances. Yeah, that's another word for it. Or your boss is giving you less pay for the same job, kind of thing. You must be suicidal to long the dollar. Just joking. Yeah. I know. I have a bearish bias on. You know that. But I'm also not denying the fact that an increase in interest rates into the future is a dollar bull event. Everything I read going into this said the Fed will going to have to sound really hawkish as tapering has already been priced in. Yes, but we have all seen the interest rates. We all seen the CPI at 5.4% or whatever it is. It is super duper high. Though it is apparently transitionary, but still, people, the CPI is very high. That is the reason for why the market is expecting them to taper, and that's why they're expecting them to raise interest rates 2 times next year, by the way. So how do I know they're expecting 2 hikes, rate hikes 2 times next year? 27th of July. There's a 70% chance that there's going to be a rate hike by July 2022. And by 14th of December, there is a 95% negotiated by the market. This is the market, that there's going to be a rate hike. Most of the people think we're going to go to 0.5 to 0.75. Most are in this group here. And they have been increasing over the past month, and has been where we have gone from 1 rate hike by 14th of December to 2 rate hikes within the last month. So I think that is very evident here. So this is kind of what you need to look into. Day traders, or daily setups people, I gave you the link to this in the Discord. If you are in my daily setups and you don't have access to my daily setups on Discord, please give me a pling, and I will be very happy to help you out, okay? Did somebody subscribe? There we are. Subham just subscribed. Thank you very much. Thank you. Welcome to the family. How will this affect the market short term? Will stocks get hammered today? That is what your favorite YouTuber wants you to believe. And if you go and look at the market right now, the market made a higher high. Hasn't really done that. It has gone a higher high. It made a new higher high. It's made a whole-time high. Sorry. So is this gonna short-term send stocks down? If there's anything that's going to be hammered, it is tech stocks. For anything else, the next thing is I am expecting some kind of reaction in the end by the market, but I haven't seen that at the moment. And the thing is, when we taper, we are going to see stock market still rising. Music Head Rick says the debt in America is so extremely high, the balance is extremely off. Yeah, I would agree. But yeah, the stock gurus want you to believe that. I have not opted for that kind of rhetoric. So you haven't found that in my channel. So sure, dude. So euro dollar did not make a higher high. Aussie dollar did not make a higher high. Just made you a better entry price to sell, I guess. Pound made you a better sell price. Pound yen is going higher. New Zealand dollar retracing back. USD CAD is made a low now, and let's see how that goes. Euro New Zealand, my beloved Euro New Zealand that I bought at 162.26. So I'm 15 pips in profit. Did I tell you that in the live earlier today? Tja, I don't know if I did that, but at least that was your entry there. As a Dutch guy, I'm looking with the Dutch eyes to America, and yeah, looking with the European eyes, looking at Americans. It's like looking at that dude in class that, it's a bit special. Not special, sorry, a bit different. I'm not saying the Americans are bad or anything, I'm just saying they're a bit different. Because they have a different way of doing things. You can't sit at a job, apparently. You get fired if you sit on a chair, even though if you have crushed your legs and you have broken bones. And I don't know where Norway is, so yeah, it's a bit weird over there. But amazing people, by the way, don't worry. Can somebody tell me why FOMC reacted to pound pairs, or why pound yen reacted to the FOMC? Because yen is a safe haven, so that will move on the risk assessment. So that will move the pound yen, and then pound itself also is a commodity, which then will rise in, or so fall in this kind of market, or rise depending, and yen will do the opposite. So New Zealand yen, pound yen are the two risk pairs you're looking to enter if you don't want to trade dollar directly, but still want to be a part of such an event like this. So it's basically the market structure, I would say, more than anything else. So yeah, yen is actually gonna be higher, but then now it's pulling back. So maybe we'll get some bearish action. My expectations for yen this year is actually not this month is actually bearish on the yen. So let's see if that happens. BOE expected to have a rate hike tomorrow. Yes, that is very true. That is why pound should maybe go higher today. But for tomorrow, I think that they're going to be disappointed. And I think that whatever the market and the Bank of England is disagreeing upon tomorrow, the pound is going to move 100 to 200 pips in whatever the direction. And that is kind of my theory. So if they really disagree upon rate hikes in the future, I think that pound is going to fall. And if they are in line, or if they are more aggressive than the market, we're going to see pound rising through the roof. But I don't think that's going to happen, though, because the market has already priced in a 1% rate hike by next year. Yeah, they are still at 0.1%. Fed will start tapering purchasing program for then by the middle of this month, Mr. Abbas. Middle of this month. Cool. Cool to see Powell being saying that inflation is transitionary, but also being the insider trader that they have been outed for. But yeah, anyways, that is that. Cool. Tell you about OPEC. I don't know what OPEC. I haven't seen anything about OPEC, but I can go and check OPEC. For a few minutes. Yeah. Yeah, that is pretty funny. RBA acting hawkishly, but actually speaking dovishly, so that's funny. But yeah, first of all, we have the crude inventories. That was 3.2 million versus 2.2. So that is sending oil lower. The other one here is, but so what Biden said was that they wanted OPEC to start producing more, increasing supply. But they're making money left and right at the moment. So it's like telling someone that is making money, you should stop making so much money. Who does that? Arctic. Can you summarize the news? Fed so far has done what we're expecting. They are tapering. Sorry. They are tapering. They are tapering at 15 billion per month, starting from mid-November. That is in a couple of 2 weeks, a little bit less than 2 weeks. We are seeing gold going up and down. We're seeing euro going up and down. A very small reaction in the market. By the way, we are seeing S&P 500 making an all-time high. We are also seeing in the market that market reacted kind of small to it. We are also seeing that that was a difference here, though. There's a lot of differences. This is fun, people. There is a lot of difference here in the and especially around this area here. There's a lot of difference. So, Treasury. Okay, cool. Will increase in holdings by at least 70 billion per month, which was earlier 80 apparently, and not 40 by 35. Maybe I saw the wrong one, by the way. Until substantial. No, not really that. Not until that. Beginning in December, the committee will increase its treasury holding securities by at least 60 billion per month. So going from 70 to 60 in 1 month, so 10 billion less next month again, and also 30 million by the mortgage-backed securities. That means they're reducing their supporting the economy. We're always waiting, expecting that to happen. And then it's prepared to adjust its further purchases if warranted by changes in the economic outlook. And the Federal Reserve is ongoing purchases holding will continue to foster smooth market. Blah, 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 blah. Yeah. So basically, that is the summary, and that is the most important. That is the most important part of it, at least. Tardik still missed it. So it's legit dollar bullishness from this point moving forward, it seems. Ciao. That's at least a theory, at least. Sir, when they start tapering, will gold fall? That is my theory. Yes. Chief, what happened? Pizza, please be quick. I've already done it, bro. I did it, bro. Seems like gold is refusing the 1767 level. I guess we're still bearish on gold. I disagree with that, Meriton. Aldi says strong movement on the market will come when there's a press conference in 7 minutes. Holding treasuries. Robson NG, can you please redo your question? Reducing the holdings in treasury. So treasury is what is the asset or the item that they are buying from the market in the market, and now they're just reducing what that item they're going to buy, which is treasury bonds, which is the yeah. So pound CAD. I don't know if we're gonna go to pound CAD. But I can also go to pound CAD. What do you want to see? This one going higher, maybe? See, learned from you. I'm happy. I'm every drop. Make ocean. Thank you very much, bro. Thank you very much, Farid. Google is asking me what I think about Two Rivers Mall. I have not been to Two Rivers Mall. Can somebody tell Google what they think about Two Rivers Mall? Hello, Abbas. You are late to the party, but I guess you are there. Yeah, we'll look at Dave's things afterwards. Great. So we haven't really seen... My account survived, by the way. But yeah, I don't know what happens to pound CAD. Maybe you can buy it. I don't know. I don't know. It's very interestingly range bound market, this one. But yeah, so gold. We can go back to gold. I'm sorry I went out of gold. But yeah, gold is okay. It's having a pullback, I guess. I think that market reaction there is very blah. That is what the market wanted. Okay. Let's go to the YouTube and the Federal Reserve. And when are we going to be as many people at 13,000 as meet Kevin people? Federal Reserve live, maybe ish. Ciao. There we are. Just waiting. Just waiting for this guy to say something. Sir, please explain about RSI. I don't know about RSI, Bear. You can also ask me the same question as why people in traffic cannot. If some people in traffic cannot behave. So. I can answer that as much as RSI. RSI is not profitable, not to my knowledge, and RSI is only constructed for you to feel FOMO and feel whatever, and it's just there to yeah. It's the bad sheep in the pack. Let's call it that. What about Aussie? Aussie has not moved much, so still holding bearish there. Yeah, and if you want to do a RSI, surely, but I've tried to make that profitable. I haven't. I'm sorry, I haven't made a profitable trade there. So it's not useless to ask me, but I can't do it for you, bro. You're following my moving average policy. Thank you very much. That is great. That is what I once wanted to do. Whoops. Whoa. That was definitely not the place to open that one. But there we go. Yeah, thank you very much, Am and Hatarax, for joining the Discord community. What else? Market jumped, by the way. So that's probably gonna be my my thumbnail for the what Fed said today. Market went higher, and all those people on YouTube, because if you just see like if you go to stock market crash, and then you filter for view count, and then you filter for this month maybe, and then you see all how much is it? It is like maximum views is 1.2 million, and there's a lot of videos here. So yeah, especially this guy. Anyways, have fun, bro. Have fun. Have fun. Have fun. Oops, there we are. Good. Thank you, SL Plug. So if you're still bearish on Aussie is still falling. Everything is still great. Euro has made 100% retracement of the eventuality a bullish move. So if you are a bull on Euro, at this moment it is not looking very great. Jerome Powell is making me money. Oh yeah, oh yeah, oh yeah. I'm just gonna make sure we don't miss this guy. It is in 15 minutes. 15 seconds, sorry, 50 seconds. What XXXX dollar pairs are where they were before the announcement, so much highly anticipated event. Yeah, actually, so we need to learn from this, people. We need to learn from this. The market didn't move at all. So next FOMC meeting, I'm just gonna expect nothing. That's probably where we are at the moment, by the way. So what's the time now? 45. Putting this sounds on. Taking my off. So we are ready at the split seconds. Whenever this guy is talking. And I will remove my face. Alright, good, good. Great. I was about to end stream, but I don't want to do that though. Sir, is it over? When will local start speaking? We'll start speaking in half a minute, half a second. So yeah. Let's welcome the Federal Governor Jerome Powell of the United States of America.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the FOMC kept interest rates near zero, and in light of the progress the economy has made toward our goals, decided to begin reducing the pace of asset purchases. With these actions, monetary policy will continue to provide strong support to the economic recovery. Given the unprecedented nature of the disruptions related to the pandemic and the reopening of the economy, we remain attentive to risks and will ensure that our policy is well positioned to address the full range of plausible economic outcomes. I will say more about our monetary policy decisions after reviewing recent economic developments. Economic activity expanded at a 6.5% pace in the first half of the year, reflecting progress on vaccinations, the reopening of the economy, and strong policy support. In the third quarter, real GDP growth slowed notably from this rapid pace. The summer's surge in COVID cases from the Delta variant has held back the recovery in the sectors most adversely affected by the pandemic, including travel and leisure. Activity has also been restrained by supply constraints and bottlenecks, notably in the motor vehicle industry. As a result, both household spending and business investment flattened out last quarter. Nonetheless, aggregate demand has been very strong this year, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. With COVID case counts receding further, and progress on vaccinations, economic growth should pick up this quarter, resulting in strong growth for the year as a whole. Conditions in the labor market have continued to improve, and demand for workers remains very strong. As with overall economic activity, the pace of improvement slowed with the rise in COVID cases. In August and September, job gains averaged 280,000 per month, down from an average of about 1 million jobs per month in June and July. The slowdown has been concentrated in sectors most sensitive to the pandemic, including leisure and hospitality and education. The unemployment rate was 4.8% in September. This figure understates the shortfall in employment, particularly as participation in the labor market remains subdued. Some of the softness in participation likely reflects the aging of the population and retirements. But participation for prime-aged individuals also remains well below pre-pandemic levels, in part reflecting factors related to the pandemic, such as caregiving needs and ongoing concerns about the virus. As a result, employers are having difficulties filling job openings. These impediments to labor supply should diminish with further progress on containing the virus, supporting gains in employment and economic activity in African Americans and Hispanics. The supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases in some sectors. In particular, bottlenecks and supply chain disruptions are limiting how quickly production can respond to the rebound in demand in the near term. As a result, overall inflation is running well above our 2% longer run goal. Supply constraints have been larger and longer lasting than anticipated. Nonetheless, it remains the case that the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, specifically the effects on supply and demand from the shutdown, the uneven reopening, and the ongoing effects of the virus itself. We understand the difficulties that high inflation poses for individuals and families, particularly those with limited means to absorb higher prices for essentials such as food and transportation. Our tools cannot ease supply constraints. Like most forecasters, we continue to believe that our dynamic economy will adjust to the supply and demand imbalances, and that as it does, inflation will decline to levels much closer to our 2% longer run goal. Of course, it is very difficult to predict the persistence of supply constraints or their effects on inflation. Global supply chains are complex. They will return to normal function, but the timing of that is highly uncertain. We are committed to our longer run goal of 2% inflation and to having longer-term inflation expectations well anchored at this goal. If we were to see signs that the path of inflation, or longer-term inflation expectations, was moving materially and persistently beyond levels consistent with our goal, we would use our tools to preserve price stability. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Our asset purchases have been a critical tool. They helped preserve financial stability early in the pandemic, and since then have helped foster smooth market functioning and accommodative financial conditions to support the economy. Last December, the committee stated its intention to continue asset purchases at a pace of at least $120 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. At today's meeting, the committee judged that the economy has met this test and decided to begin reducing the pace of its asset purchases. Beginning later this month, we will reduce the monthly pace of our net asset purchases by $10 billion for Treasury securities and $5 billion for agency mortgage-backed securities. We also announced another reduction of this size in the monthly purchase pace starting in mid-December, since that month's purchase schedule will be released by the Federal Reserve Bank of New York prior to our December FOMC meeting. If the economy evolves broadly as expected, we judge that similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by the middle of next year. That said, we are prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to support accommodative financial conditions. Our decision today to begin tapering our asset purchases does not imply any direct signal regarding our interest rate policy. We continue to articulate a different and more stringent test for the economic conditions that would need to be met before raising the federal funds rate. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you. We'll go to Nick at the Wall Street Journal.
Hi, Nick Timorous.
He basically just said what we're expecting all the time, but yeah, anyways.
Raise rates once or twice next year. Are they wrong?
So, I would say it this way. We try to focus on what we can control, and that is how to communicate as clearly as possible in this highly uncertain world how we're thinking about the economic outlook and the balance of risks, and how policy will evolve in that case, and also in the cases which are frequent where the economy evolves in unexpected ways. So the focus at this meeting is on tapering asset purchases, not on raising rates. It is time to taper, we think, because the economy has achieved substantial further progress toward our goals, measured from last December. We don't think it's time yet to raise interest rates. There is still ground to cover to reach maximum employment, both in terms of employment and in terms of participation. Getting to your question, our baseline expectation is that supply bottlenecks and shortages will persist well into next year, and elevated inflation as well, and that as the pandemic subsides, supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline from today's elevated levels. Of course, the timing of that is highly uncertain, but certainly we should see inflation moving down by the second or third quarter. The time for lifting rates and beginning to remove accommodation will depend on the path of the economy. We think we can be patient. If a response is called for, we will not hesitate. So what I will tell you is we're watching carefully to see whether the economy evolves in line with our expectations, and policy will adapt appropriately. And that's what I would say.
Well, based on, if I could follow up, based on your current outlook for the labor market, do you think it's possible or likely even that maximum employment could be achieved by the second half of next year?
So if you look at the progress that we've made over the course of the last year, if that pace were to continue, then the answer would be yes. I do think that that is possible. Of course, we measure maximum employment based on a wide range of figures, but it's certainly within the realm of possibility.
Thank you.
Thank you. Next, we'll go to Gina at the New York Times.
Hi, Chair Powell. I was wondering if you could detail a little bit how you're thinking about wages at this moment. Obviously, we're seeing strong wage growth, particularly for people in sort of lower income fields. I wonder if you see that as a positive thing or as a potential start to a wage price spiral, and sort of how you sort of delineate those two things.
So wages have been moving up strongly, very strongly. And in particular, I would point to the Employment Compensation Index reading that we got last Friday. Now, in real terms, they had been running a little bit below inflation, so real wages were not really increasing. I think with the ECI reading, it becomes close to maybe not increasing, but close to back to zero in terms of the real increase. So wages moving up, of course, is how standard of living increases over the years for generation upon generation. It's very important, and it's generally a good thing. The concern is a somewhat unusual case where if wages were to be rising persistently and materially above inflation and productivity gains, that could put upward pressure on or downward pressure on margins and cause companies to their employers really to raise prices as a result. And you can find yourself in what we used to call a wage price spiral. We don't have evidence of that yet. Productivity has been very high. The ECI reading is just one reading. Again, if you look back, so we'll be watching this carefully. But I would say that at this point we don't see troubling increases, in wages, and we don't expect those to emerge, but we'll be watching carefully.
Next, we'll go to Steve Leisman from CNBC.
Thank you, Mr. Chairman. I wonder if you could perhaps give us your thinking about the trade-offs between inflation and unemployment. You've talked about the shortfall in unemployment or employment relative to before the pandemic, and yet you have inflation, which is affecting everybody. Are we at or close to a point where the risk of inflation is greater than the benefit that you'd for recovering these lost jobs, so that now from a risk management standpoint, it makes sense to move more aggressively on rate hikes? And kind of a related question, the statement today says you'll keep policy accommodative until you hit that 2% inflation target. Our surveys show looking for 5% inflation this year, 3.5% next year. It sure seems like you're on track to modestly or moderately exceed that 2% target. Thanks.
Yeah, so I'm not sure I totally got your first question, but I would say, in fact, could you just quickly, succinctly say your first question again?
Sure. The idea that the trade-off between inflation and unemployment, that you would keep policy accommodative to put this 5 million folks or find these 5 million jobs again. At the same time, all Americans will be suffering from higher inflation. Is that trade-off worth it, or is it better or smarter to raise rates right now to combat inflation and perhaps not lean so heavily on the employment side of the mandate?
Yeah, so this isn't the traditional Phillips curve situation where there's a direct trade-off, where that's really what we're talking about. The inflation that we're seeing is really not due to a tight labor market. It's due to bottlenecks, and it's due to shortages, and it's due to very strong demand meeting those. So I think it's not the classical situation where you have that precise trade-off. But in this situation, we do have a provision in our statement on longer run goals, as you know, that says when those two things are in tension, what we do is we take into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with the mandate. So we used to call that the balanced approach paragraph. We have to think about the amount of the deviation. We have to think about the time it will take. And we have to make policy in a world where the two goals are in tension. It's very difficult. But what it really boils down to is something that's common sense, and that is risk management. We have to be aware of the risks particularly now the risk of significantly higher inflation. We see shortages and bottlenecks persisting into next year. We see well into next year. We see higher inflation persisting, and we have to be in position to address that risk should it become really a threat should it create a threat of more persistent longer-term inflation. And that's what we think our policy is doing now. It's putting us in a position to be able to address the range of plausible outcomes.
Thank you. Next, we'll go to Colby Smith at the Financial Times.
Thank you. Chair Powell, what are the economic conditions that would perhaps warrant a faster pace of tapering? And I'm wondering how you would also characterize the risks that the Fed may actually need to accelerate that process eventually. Thank you.
So I guess, as I said in my opening remarks, assuming the economy performs broadly as expected, the committee judges that similar reductions in the pace of net asset purchases will likely be appropriate each month, and we're prepared to deviate from that path if warranted by changes in the economic outlook. So I'm not going to give you a lot more detail on what that might be. Of course, if we do see something like that happening, if it becomes a question, then we'll communicate very transparently and openly about that. But I'm just going to leave it with the words that are in the statement. Sorry, was there a second part?
Yeah, it's just on characterizing the risks that you might actually have to do so later on.
I would just leave you with the words we have here. We are prepared to speed up or slow down the pace of reductions in asset purchases if it's warranted by changes in the economic outlook. And again, if we feel like something like that's happening, then we'll be very transparent about it. We wouldn't want to surprise markets. We'll say, in light of this factor or these factors, we are considering doing this, and then we would either do it or not do it. But but I'm not going to start making up examples of what that might be today. Thanks.
Thank you.
Next, we'll go to Rachel Siegel at the Washington Post.
Hi, Chair Powell. Thank you so much for taking our questions. You mentioned at the beginning that the Fed understands the difficulties that high inflation poses for individuals and families, especially those with limited means. What is your message to those families or consumers that are struggling with higher prices right now? And do you feel that your expectations around transitory inflation that message is reaching them? Thank you.
Yeah, so first of all, it is our job and we accept responsibility and accountability for inflation in the medium term. We're accountable to Congress and to the American people for maximum employment and price stability. The level of inflation we have right now is not at all consistent with price stability. By the way, we're also not at maximum employment, as I mentioned. So I would want to assure people that we will use our tools as appropriate to get inflation under control. We don't think it's a good time to raise interest rates, though, because we want to see the labor market heal further. And we have very good reason to think that will happen as the Delta variant declines, which it's doing now. As I mentioned, so transitory is a word that people have had different understandings of. For some, it carries a sense of short-lived. And that's there's a real time component measured in months, or let's say. Really, for us, what transitory has meant is that if something is transitory, it will not leave behind it permanently or very persistently higher inflation. So that's why we took a step back from transitory. We said expected to be transitory, first of all, to show uncertainty around that. We've always said that, by the way, in other contexts. We just hadn't done it in the statement. But also to acknowledge, really, that it means different things to different people. And then we added some language to really explain more what we're talking about in paragraph 2 and paragraph 3. We said that supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases. Then we said progress on vaccinations and an easing of supply constraints are expected to support continued gains in economic activity and employment, as well as a reduction in inflation. So we're trying to explain what we mean, and also acknowledging more uncertainty about transitory. So it's become a word that's attracted a lot of attention that maybe is distracting from our message, which we want to be as clear as possible. Ultimately, the only other thing I would say is, look, we understand completely that it's particularly people who are living paycheck to paycheck or seeing higher grocery costs, higher gasoline costs. When the winter comes, higher heating costs for their homes. We understand completely what they're going through, and we will use our tools over time to make sure that doesn't become a permanent feature of life. Really, that's one of our principal jobs, along with achieving maximum employment, and that's our commitment.
Thank you. We'll go to Chris Rugaber of the Associated Press.
Great. Thank you, Michelle. Thank you, Chair Powell. Well, I wonder if you could update us. You talked about getting back to full employment. And so could you update how you define that? I mean, a few months ago, yourself and other Fed officials talked about getting back to the pre-COVID labor market. There was even hints you might try to do something better than that. Now we hear talk of, as you mentioned, people retiring, and there's talk of not being able to get back all the jobs back because of that and other trends. You did mention the prime age folks. So can you give us some examples of things you're looking at specifically to measure full employment? Will you be looking at prime age employment population ratio, for example? And if so, do you need to see that get back to pre-COVID levels to achieve maximum employment, or is there something short of that would work? Thank you.
So, thanks. So maximum employment is it's a broad-based and inclusive goal that's not directly measurable and changes over time due to various factors. You can't specify a specific goal. So it's taking into account quite a broad range of things, and of course, employment levels of employment, participation, are part of that. But in addition, there are other measures of what's going on in the labor market. Like wages is a key measure of how tight the labor market is. The level of quits, the amount of job openings, the flows in and out of various states. So we look at so many different things, and you make an overall judgment. Now, the temptation at the beginning of the recovery was to look at the data in February of 2020 and say, well, that's the goal, because we didn't know that's what we knew, that was achievable in a context of low inflation. I think we're we're learning now. We have to be humble about what we know about this economy, which is still very COVID affected, by the way. A lot of what we're seeing in the last 90 days is because of Delta. We were on a path to a very different place. Delta put us on a different path, and we see these things. But so I think we're going to have to, ideally we would see further development of the labor market in a context where there isn't another COVID spike. And then we would be able to see, I think, a lot. We would see how does participation react in that world, in that sort of post-COVID world. Right now, people are staying out of the labor market because of caretaking, because of fear of COVID to significant extent. We thought that that schools reopening and elapsing unemployment benefits would produce some sort of additional labor supply. That doesn't seem to have been the case, interestingly. So I think there's room for a whole lot of humility here as we try to think about what maximum employment would be. We're going to have to see some time post-COVID so that we know, or post-Delta anyway, to see what is possible. And I think the learning for those of us who lived through the last cycle is that over time, you can get to places that didn't look possible. Now, what we also have now, though, is we have high inflation. So we have a completely different situation now where we have high inflation, and we have to balance that with what's going on in the employment market. So it's a complicated situation, and I would say we hope to achieve significantly greater clarity about where this economy is going and what the characteristics of the post-pandemic economy are over the first half of next year.
Thanks. We'll go to Howard Schneider at Reuters.
Thanks for doing this. So given that answer about employment, I would like to get back to Steve's question a little bit. On a headline basis, just as it's evolved this year, do you feel that the two tests on inflation have been met?
Sorry, the two tests?
The two tests in the statement, the guidance that it has to hit 2% and be on track to moderately be above it for 2%. Has the economy cleared that?
That's a decision for the committee. I would put it to you this way. When we reach maximum employment, when we reach a state where labor market conditions are at maximum employment in the committee's judgment, it's very possible that the inflation test will already be met. We're aware that language sounds a little out of touch with what's going on, but we're not at maximum employment. When that is the case, we'll look to see whether the inflation test is met, and there's a good chance that it will be if you look at how inflation has evolved in the last year and a half.
So to follow up here, so you're not willing to commit?
Snapsnell, thank you for subscribing to the channel.
For some time. So given that, I mean, how should we render what moderately and moderately over and for some time mean?
What I'm really saying is that question is not before us right now. We had the question on when to taper. We've now answered that question and the speed of it and all that. We have not focused on whether we meet the liftoff test, because we don't meet the liftoff test now because we're not at maximum employment. What I'm saying is, given where inflation is and where it's projected to be, let's say we do meet the maximum employment test, then the question for the committee at that time will be, has the inflation test been met? And I don't want to get ahead of the committee on that, but the answer may very well be yes, it's been met. But we're not asking that question today because we're not running the liftoff test. We're not evaluating the liftoff test today. We didn't have that discussion at today's meeting. We did talk about the economy and the development of the economy, but we didn't ask ourselves whether the liftoff test is met, because it's clearly not met on the maximum employment side.
Thank you.
Thank you. Let's go to Matthew Boesler at Bloomberg.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So when you're looking at this question of assessing whether or not the U.S. economy is at maximum employment, do you have a framework for making that judgment that is independent of what inflation is doing? And if not, does it kind of complicate that assessment given all of the uncertainty about inflation right now and the inclination to believe that the high inflation we're seeing is not related to capacity utilization in the labor market? Thank you.
So we don't actually define maximum employment as we define it in terms of inflation, but of course there is a connection there. Maximum employment has to be a level that is consistent with stable prices. But that's not really how we think about it. We think about maximum employment as looking at a broad range of things. You can't just look at, unlike inflation, where you can have a number. But with maximum employment, you could be in a situation hypothetically where the unemployment rate is low, but there are many people who are out of the labor force and will come back in, and so you wouldn't really be at maximum employment because there's this group that isn't counted as unemployed. So we look at a range of things, and the thing is, by many measures, we are at a very tight labor market. I mentioned quits and job openings and wages and things like. Many of them are signaling a tight labor market, but the issue is how persistent is that? Because you have people who are held out of the labor market, of their own. They're holding themselves out of the labor market because of caretaking needs or because of fear of COVID or for whatever reason. They're staying out. And it's clear that there are, with tremendous demand for workers and wages moving up, it does seem like we're set up to go back to a higher job creation. So that would suggest that you're not at maximum employment. So at the end of the day, it is a judgment thing. But of course, at the end of the day, it also has to be a level of employment that's consistent with price stability.
And if I could just follow up briefly, you've talked a little bit about this possibility that the two goals might be in tension and how you would have to balance those two things. Could you talk a little bit about what the Fed's process for balancing those two goals would be in the event that, say, come next year, you decide there's a serious risk of persistent inflationary pressures despite ongoing employment shortfalls?
Yeah, I mean, again, it's a risk management thing. It's not. I can't reduce it to an equation, but also ultimately, it's about risk management. So you want to be in a position to act to cover the full range of plausible outcomes, not just the base case. And in this case, the risk is skewed. For now, it appears to be skewed toward higher inflation. So we need to be in a position to act in case it becomes necessary to do so or appropriate to do so, and we think we will be. So that's how we're thinking about it. And I think, though, that judgmentally too, it's appropriate to be patient. It's appropriate for us to see what the labor market and what the economy look like when they heal further. We know that we were on a path to a different place, as I mentioned, when Delta arrived. And Delta stopped job creation. It stopped that transition away from a goods-focused economy where there's excess demand for goods because their services are not available, people are not traveling. That transition itself could help bring inflation down because presumably people would spend a little less on goods while they start spending more on travel and all sorts of travel services and things like that. So that we want to see that healthy process unfold as we decide what the true state of the economy is. And we think it will evolve in a way that will mean lower inflation. Bottlenecks should be abating. We start to see that now with some of them, but overall they haven't gotten better overall, and we're very aware of that. So that's really how we're thinking about it. We're thinking that time will tell us more. In the meantime, we don't think it's time to raise rates now. If we do conclude that it's necessary to do so, then we'll be patient, but we won't hesitate.
Thank you. Let's go to Edward Lawrence at Fox Business.
Thank you, Mr. Chairman, for taking the call. So the Federal Reserve, I want to talk about climate change. The Federal Reserve released a statement today, says the Federal Reserve supports the efforts to identify key issues and potential solutions for the climate-related challenges most relevant to central banks and supervisory outcomes. Is this putting us on the path to regulate what banks can offer loans on or invest in, like coal plants or fossil fuels?
So that's not a decision for bank regulators or for any agency. That's a decision for elected representatives. So we feel that any role that we have, and we do think we have a role in climate change, it relates to our existing mandates, and our existing mandates are really prudential regulation of financial institutions. We expect them, and the public will expect us to expect them to understand and be in a position to manage their risks. So that's physical risk and it's transition risk for climate. And by the way, the large financial institutions are doing this already, and you know we think that's right within our mandate. There's also a financial stability question, the overall stability of the financial system. And so from that standpoint, we can do research. We can try to help understand what will the pathways be through which climate change affects the economy, both physical risk and transition risk. That's what we can do, and that's what we will do, and we'll do it well within the frame of our existing mandates. We'll do it well. We're not the people who will decide the national strategy on climate change. That has to be elected people, and not so much us. But we feel like we have that narrow mandate, and we will do it well.
Thank you.
Great. Thank you. Victoria Guida at Politico.
Hi, Chair Powell. So the Fed recently announced that there's going to be new conflict of interest rules for investments by Fed officials. And this follows, obviously, the resignation of 2 regional Fed presidents. And I'm just wondering, do you think that there's more that you will need to do to rebuild the credibility of the Fed, such as, requiring officials to put their assets in blind trusts? And also, if you could speak to whether you have any concerns that any rules or laws were broken by Fed officials. Thank you.
So let me just say that this system, the ethics system we had in place, had been in place for decades, and had, as far as we know, served us well. And then that was no longer the case. And so we had no moment of denial about that. As a group, we stepped in and we took the actions that we took. And within one FOMC cycle, we announced a new set of rules to try to put us back where we need to be, which is we need to have the complete trust of the American people that we're working in their interest all the time. Absolutely critical to our work, as it is for any government agency. And I feel like this called that into question. So we reacted. I would characterize it strongly and forcefully. If there were other things that we could do that were reasonable, we would certainly do them. So you asked about blind trusts. The overall authority for ethics around these issues in the federal government is the Office of Government Ethics, OGE, and they have a long-held position. Which is not favorable to blind trusts. They do not encourage them. They don't think they're effective. They think they're cumbersome, and they think there are better ways to get at the things that need to be done. And those are the things that we're actually doing. So I don't know that there are any blind trusts for that reason, because they're the regulator. They say this on their website if you look. In terms of laws broken, I asked the Inspector General to look to see whether there were rules broken and whether there were laws broken. And I won't speculate on that, but that is with the Inspector General now, and of course, out of my hands.
Thank you. We'll go to Mike McKee at Bloomberg.
Mr. Chairman, the critics of your patience policy argue that given the long and variable lags with which monetary policy works, that you are likely to end up, given inflation, by having to raise rates faster and farther than you would have liked, and therefore send the economy into recession. Given the fact that basically your forecast has been chasing inflation over the last year, and now you're talking about it not coming down till the second or third quarter, why would they be wrong in thinking that?
Well, so let me say what's happened, and we're very, very straightforward about it, is that inflation has come in higher than expected, and bottlenecks have been more persistent and more prevalent. We see that just like everybody else does, and we see that they're now on track to persist well into next year. That was not expected not expected by us, not expected by other macro forecasters. Now, let me say, it's difficult enough to just forecast the economy in normal times. When you're talking about, global supply chains in turmoil, it's a whole different thing. And you're talking about a pandemic that's holding people out of the labor force for reasons that we can sample, but we don't have a lot of experience with this. So it's very, very difficult to forecast and not easy to set policy. So we have to set policy, though. So that's what we're doing. And, so to look at your question this way, I don't think that we're behind the curve. I actually believe that policy is well positioned to address the range of plausible outcomes. And that's what we need to do. I do think it would be premature to raise rates today. That's not, I don't think that's controversial.
Oh, please give this this live a like if I have given you any value whatsoever, explain anything to you. It would mean the world, and to YouTube.
Certainly, I don't know anyone arguing for that today, and the reason is that there's still ground to cover to get to maximum employment, and we don't want to stop that when there's good reason to think. There's still good reason to think, although it's been delayed. Clearly, there's good reason to think that the economy will reopen, particularly if we do get past, significant outbreaks of COVID. That's when we're really going to see what the characteristics of the labor market are. And, I think, the bottlenecks that we're seeing in global supply chains around goods, and frankly now at our own domestic ports, because demand is stronger than the capacity of those ports, those things are going to work themselves out. We have a flexible economy. It'll take some time, but, it took the experts managed to create a vaccine faster than certainly than I expected, and I think this stuff will work itself out over the course of next year. That is my baseline understanding, and that's very widely held among people. But we are prepared for different eventualities, and we will use our tools to achieve price stability and maximum employment. And we're going to let the data lead us to where we need to go. Our policy will adapt, and has already adapted to the changing understanding of inflation and of bottlenecks and the whole supply side story, which is also partly a demand story. So our policy will continue to adapt as is appropriate.
Thank you. Let's go to Nancy Marshall-Genzer at Marketplace.
Hi, Chair Powell. Thanks for taking our questions. So you announced that the Fed is going to taper at a rate of starting at $15 billion a month, and that's more than twice the pace of the last taper. So why are you tapering faster this time?
The economy is in quite a different place than when we tapered back in, I guess it was 2013. We were much farther away from maximum employment. Inflation was much lower. This is an economy where demand is very, very strong, and job openings substantially exceed the number of unemployed people. So the need for further stimulus is far less than it was in 2013, where we still had quite a ways to go. I mean, after we began that taper, it was still many years before we reached what I would characterize as conditions consistent with maximum employment, let alone price stability. So this is quite a different situation, and the committee unanimously felt today that we had met the test that we'd articulated, and this was appropriate. And this is faster than what people had expected 6 months ago. It's earlier and faster, and that's because as I mentioned, our policy has been adapting to the situation as it evolves, as it's clarifying itself, and that's partly because we see inflation coming in higher. So,
thank you. Let's go to Mike Derby.
Yeah, thank you for taking my question. I wonder if the Fed has given any thoughts yet to the end game for the balance sheet in terms of, once you get the taper process complete, will you hold the balance sheet steady, or will you allow it to start passively winding down? And then in a related question, do you have any greater insight into what Fed bond buying actually does for the economy in terms of its economic impact? Have you been able to, measure it or quantify it in any fashion? Because I'm sure there's often been questions about what is bond buying actually doing to help the economy.
Sure. So in terms of the balance sheet, those questions that you mentioned, we haven't gone back to them. Now that we've tapered, I expect that that's exactly what we'll do in coming meetings, and we'll do it in an orderly fashion. And we'll talk about reinvestment and all those things. And we don't have to make decisions on those yet. But typically when we're doing a new subject like that, we'll have a series of briefings and discussions, and that's what we will now begin to do. In terms of the effect of asset purchases on the economy, so there's a tremendous amount of research and scholarship on this, and you can kind of you can find different people coming out with different views, but I would say the most mainstream view would be that you're at the effective lower bound. So how do you affect longer term rates? There are two ways. One, so you can't lower rates. Let's say you can't lower rates any further, hypothetically. So you can give forward guidance. You can say we're going to keep the rates low for a period of time, either a specific period until certain conditions are met. The markets will do the math, and that'll have an effect on longer-term borrowings, even 10, 30 years out kind of thing. So that's one thing. The other thing you can do is you just go buy those securities, buy longer-term securities. That will drive down longer-term rates and hold them lower. And rates right across the rate spectrum matter for borrowers. So lower rates encourage more borrowing, encourage more economic activity. People that you can service your debt, you have more free cash flow. It's not different from what we do at the short end. So that was discussed long before anybody did it. That was, I think, Milton Friedman said that was what you could do if you were pinned at the lower bound many years ago. So anyway, that's how it's supposed to work. And it's quite hard to be precise about these things because you only have one economy and you can't run two different economies right next to each other and do a scientific experiment. But most of the findings are that it does support economic activity in the way that you would expect, which is to say, at the margin, more economic activity with lower rates, which is why we do what we do. More accommodative financial conditions lead to more economic activity over time with a lag. So I think that's the main finding I would say on QE.
Thank you.
Thank you. We're going to go to Paul LaMonica at CNN.
Chair Powell, you've addressed already questions about the stock purchases that took place from some of the regional Fed presidents, and addressing the American people to make sure that they can trust the Fed. I was wondering also, in light of the fact that we now have questions about your own future, whether or not President Biden will nominate you for a second term, what would you say to the president and to senators that potentially will be voting on a renomination about this specifically with regards to your future as Fed chair for a possible second term?
So I will answer your question, Paul, but I'm not going to have any comment whatsoever on the renomination process at all. I will say, though, that I have briefed administration officials and I've briefed people on Capitol Hill in detail about what we did and why we did it, and seeking their feedback, getting their reaction. But this is part of my job. Congress has oversight over the Fed, and we take that very seriously. So if you're on our one of the two committees that has oversight over us, then I'm in regular contact with you probably. And when something like this comes up, I'm on the phone. I'm offering to meet with you and explain it to you and answer your questions and identify any concerns people might have. That's just part of my job. So I do that. I don't talk about particular conversations, but you can assume I'll always do that, and I certainly did it in this case.
Thank you.
Thank you. Let's go to Hannah Lang at the American Banker.
Hi, I wanted to ask about the supplementary leverage ratio. Is the Fed still planning on seeking comment on ways to permanently adjust that? And how concerned are you ultimately about banks' willingness to intermediate in the Treasury markets without a permanent fix?
So I don't have anything for you on supplemental leverage ratio right now. We are looking at ways to, if there are ways we can address liquidity issues through that channel. We also have there's a working group headed by Treasury about over Treasury markets and what happened in the acute phase of the pandemic and what structural things may need to be done. So that would be part of that work stream. And I I know that there's a lot going on. I'm not sure when that report will be out. But so it's work underway. That's one of the many issues that are part of that, along with things like central clearing of treasuries, greater central clearing, and many other ideas. It's important that we have a liquid treasury market. It's a huge public benefit that we do, and I think we need to do those things that enable that, while also assuring safety and soundness of our largest financial institutions, who tend to be the main dealers. So we have to make sure that's always a first order concern as well.
Thank you.
Thank you. Let's go to Brian Chung at Yahoo Finance.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. So just to expand on the ethics conversation, you talked about how you engaged with people on Capitol Hill and in the administration. You talked about what you've done already, but I'm just wondering if you could take a step back and just assess whether or not there was reputational damage as a result of that, either from the public's view or from the financial community's view of the Federal Reserve's independence. And then secondly, do you look back on the whole episode and have thoughts on your individual responsibility in preventing something like this from having happened?
So I think it's too soon to say what the reputational damage is. I think from the very beginning, my reaction was we need to deal with this straightforwardly, transparently, and forcefully. And that's what we're going to do. I mean, it means everything to me that we do whatever it takes to make sure that nothing like this happens again. And I like to think we've made a real good start on that. If you think about it, you cannot execute a trade unless it's pre-cleared, and then you have to say execute. It's not even a trade. Really, there's no trading going on. This is for investment and getting liquidity for life's expenses. But you then have to wait 45 days to actually execute that sale or purchase. So I think it's a pretty good system. We'll always be looking to make it better. So in terms of our independence, I think we will address this, and I think we have, and I like to think it's enough. But it's going to, we're just beginning to implement it. We have to write the rules, which we're doing, as quickly as possible. We need more people. We're going to have to resource this much more significantly here at the board, and also we're going to need appropriate technology because, the Fed has system has more than 30,000 employees. Not all of them, far fewer of them will be covered by this. But the senior officers who will be covered by this will have to have technology access, and it's going to have to work efficiently. So there's a lot of work to do to implement it. Again, I would just say this system has been in place for decades, and it was in place when I took over. It was in place for at least the last 3 or 4 chairs, and it was what it was, and it proved to have weaknesses in it. And part of that was that it wasn't uniformly enforced across the system. I'm a big believer in the value of the Federal Reserve System and the reserve banks. But you had 12 different ethics officers at 12 different banks, and you had ethics people here. And compliance wasn't all exactly the same. It was a little bit different and uneven. And also the rules were, we didn't imagine the problems that happened. And they may have actually been, I don't know this, but they may actually have been in compliance with the specifics of our rules. They were clearly not in compliance with the part of our rules that said don't do anything that would create a bad appearance. I mean, that's clear. This was a bad appearance. So anyway, what can we do? We are where we are. It happened, and we just have to deal with it forthrightly and transparency and own it and step up to this, meet this moment. I'm totally committed to doing that. And again, if there are better ideas, I'd love to hear them. But I think we have so far made a good start.
You say you spoke with administration officials. Did that include the president?
I'm not going to answer who I spoke to at all. I'm not going to give you any names. So don't take that as a yes or a no. I'm just not going to start down that road.
Okay, thank you. We're going to go to Jeff Cox for the last question.
Yeah, thank you. Chair, I just want to dig a little bit deeper on employment. We've seen what's been called the Great Resignation.
Hello everyone. Hope you guys are having fun in the comment section. I'm definitely having fun there. So I can do some kind of summary there. I have been throughout commenting pretty well on your on whatever you guys want me to do. I've been commenting quite frequently on what has been said. So first of all, they did taper. That is kind of now confirmed by mid-November 2021. The other thing that is confirmed is that there is no time to increase interest rates now. That is, we need to be patient about that. Hope you guys can hear me. Great. And then we also then need to be that wages are rising rapidly, but it's not because of a constraint or like wages increases sometimes because of inflation. Like anything else is getting expensive. So for me to still be able to pay for what I need to have a higher pay. That is actually a valid reason. And in some cases, wages goes higher because you have to pay better for the competence you want. And that has not yet been so far happening across the economy. And this guy is about to ask about the migration that's been happening, generally speaking, in the American economy at the moment, where many people has left jobs. Restaurants can't get people because it's one, they are getting paid, what was it, up until now, $28 an hour, 28 instead of 20 or 15 or whatever they were paid at the restaurant. So of course it was way more profitable or better for them to just stay home. So that's maybe something we're going to see into the future now. We also saw that the unemployment rate for the labor market for September at 4.8%, he said was subdued. So he also said that the worker wages was going higher. August and September was an 800,000 average, and instead of 1 million, that was the 2 previous months. So it wasn't as strong unemployment numbers as he was hoping for. And then they are also attentive to the risk. Risk means that inflation goes way higher than it is right now. And they have kind of seen their role to be in the market as a stability provider, kind of now reducing more and more. So I'm just reading through your comments though. Don't forget about climate change. And they talked about climate change for some absolutely funny reasons. They also talked about 2 governors resigned because of insider trading. Hello. That is currently at the Attorney General. That is, of course, getting investigated. Yeah, Diana, can't you do the Spanish version here? Please, because there's Spanish people in here. I don't speak Spanish. Nada señor, nada señorita. La Spanish, por favor. Question, Ivan, if I may, what do you think about NFP this Friday? That's going to be fun, bro. That's going to be fun. What else did he say? I probably jumped over a whole ton of things. So they are seeing that, let me find that thing there. They're seeing that there's no time to taper at the moment. No, sorry, there's no time to increase interest rate, which is actually the driver of the dollar bullishness and the dollar bearishness. And the other thing that he says that that the real GDP growth has slowed down. COVID cases are declining. Economic growth have built up some momentum. We expect solid growth this year. The growth rate of the jobs have slowed down. The rate of the participation are still subdued. People are still staying at home. Some of them at least. Unemployment rates understates the unemployment shortfall. Supply and demand imbalances have resulted in significant price hikes. And he still says inflation is transitionary and bottlenecks are affecting how supply can respond to demand. And it's the bottlenecks that is creating this inflation. What does bottlenecks mean? A bottleneck is a thing that makes you not able to operate at maximum capacity. But bottleneck can be an employee that doesn't do his job. A bottleneck can be a machine that you have that doesn't work faster. If it works faster, it does a bad job. If it does a bad job, you don't sell. So that is a bottleneck. Another bottleneck, if nobody comes and picks up your products to ship them out, well, your products are staying where they are, nobody's buying it, or less people are buying it. That is also a bottleneck. A bottleneck is reducing your ability, reducing your ability to operate at a maximum level. For any businesses, generally speaking, inflation is substantially above the 2% target. So inflation has been met. Bottlenecks are lasting longer than projected. So all of this summary here is that they're going to taper. I haven't seen when they're going to stop. They said, well, we're going to look into it. I said, and we're going to adjust along the way. They're going to taper in November. They're going to taper even more in December. And then they're gradually going to taper more and more for each month that it goes. So if we go from, so we are 120, whoops, let's do a math here. Let's do some quick math. So if it starts at 120, now we are at 105. So that's 105. This is deck. It's in 105. And then there was at least down to 95 as far as I remember. Sorry, that was November. And then this is December, so 95. And then 10, 85 by Jan, 75 by Feb, 65 by March, 65. Can't even type. 55 March, April, 45 by May. And then 35 by June, and then 25 by July. So if my kind of a 10 a month reduction every month, then we are ending up in July at 25 billion per month, or just cut it by July 2022. So that's kind of what I guess they're seeing at the moment. I just did a small math there. Sorry, Diane. I'm sorry. How do we merge information from the Fed with seasonality of the dollar for November? Thank you. They still go hands in gloves. You're bearish on the dollar now. What do you think? Sure, Ahmad. Sure. It's a supply issue, not a demand issue. Denilson, please speak English. Well, just use Google Translate, and if it doesn't work out well in Google Translate, then sure, I guess it goes. So I guess there is a Spanish disagreement in the comment section, I guess. But yeah, sure. So right now I'm supposed to have a daily setup, $30 a month, I guess. Right now, I am mentors. If you go to Eivindfx.com, Eivindfx, the YouTube name here, .com, you will find some courses there. Fired asked if there's something for $99 a month. Yes, there is something for $99 a month. That is confirmed. But still, free out there is still my strategy. I think there's 3 videos on my strategy. There is pivot points, indicators, an introduction to pivot points, all free. Don't worry. I'm going to be live. I don't know if I'm going to be live tomorrow. My wife She said I needed to go somewhere when I'm going to be live tomorrow. So I don't know what I'm gonna do about that. I still want to help you guys out, but you know, family first, I guess. Hello, Ivan. What is your time you usually go live? What time zone? New York Open, 3 p.m. Kenyan time. That is 1 p.m. Berlin time. And that is 7 a.m. New York and 7 a.m. Malaysian. So wherever you are in the world, there you go. Pablo says, so let's do a poll then. You guys need to really say if you need me tomorrow. So if you want me to come live tomorrow, please type yes. And if you don't need me to come tomorrow, type no. So Pablo wants me to come tomorrow. Okay, is there anybody else out there? That's probably where things is. So probably is the only one. JT, Ivan, Hard Work, Basili, Shuran. Oh, family first. And Juan says, Antang says it's family first. Subadip says yes. Abba says yes, no. Family first, brother. Exotic says families first. Big Dog is freezing his head off. I don't know what that means. J.K. Marcus says yes. Diane says yes, but family first. At your disposal. Take a break. J.K., did I not answer your question? I thought I answered it, bro. I've answered it. So yes, they still go together. Wallet first. Yeah, if I was ever driven by the money. If it doesn't result, sleeping on the sofa. That is the comment of the year. Harold, that is the comment of the year. If it doesn't make you sleep on the sofa. TP, APK, Android gameplay is sleeping on the job, bro. You're sleeping on the job. You're supposed to be at like 2 hours ago, bro. So, yeah. All right. I'm gonna make a video about this. So if you see it tomorrow morning or whenever you see it, whenever I have made up to make a high energy video for 10 minutes. Hope that I'm able to do that. I will do that for you. Do a summary so that you all can do that. You all can go through that and watch it until the end. If you don't bother, just go to the toilet. If you see the video, don't really bother. Go to the toilet, put it on, come back, watch some YouTubes on your phone, on your or whatever you read on the toilet. Come back, and it's over. All right. We're also family. You're my family. I love you guys. Thank you very much for being here. I love you. Mwah. See you on NFP on Friday, bro. NFP on Friday. Gotta be boom. Let's make some money.